Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, December 1st, 2016. I wanted to take a look at the broad markets in this video. We'll keep this one relatively brief. I know I did ran a little long on that IWM small cap video yesterday. There was a lot to cover, but just so you know, my goal is to keep all these videos going forward, to try to keep them under 30 minutes, ideally in the 20-minute range, and then occasionally do some 10-minute videos, plus or minus 10 minutes, so quick updates from time to time, and just not get into all the minutia. There are a lot of details with technical analysis, and that's why some of these videos go longer than expected. I try to get it all in there. So I'll just focus on the salient points here, and what we'll talk about is the recent market action. And before I do that, a very brief overview of what's gone on the last couple of years. No, so the gist of what's happening here, and I've continued to harp on this. I think everybody's acutely aware. The market is in really a 3-year trading range. If I go right here, I'm going to grab that. I'm going to move to the left. You can see from the pop-up box on the left, down there towards the bottom in white, it says 3 years. And again, what I'm looking at is this point right here. Or I'll shade it in for you. This is just one big trading range. Again, nothing that we aren't all aware of, but the fact that yes, we are at the upper end of that trading range. We'll give that much to the bulls, but this is the 3-year trading range here, going back to this point right here, and more importantly, here's where we were 2 years ago. If I drag and move over, we're only a couple of percentage points above where we were trading 2 years ago in the market, and I'm using the S&P because that's really considered one of the most widely used proxies for the stock market. So there it is. It's go nowhere. What does that mean? Well, this is simply a battleground between buyers and sellers. And I was reading an article today, and it brought a good point. There's in the last couple of years, the buyers have stubbornly held on to stocks despite bearish news, bearish technicals. We've had some breakdowns and other things there, and you have to say, and that is net, especially when you're in a primary uptrend, that is bullish. Yes, they're not taking the market any higher. Again, talking marginal new highs. So on face value, the fact that they haven't sold despite a lot of bad news events, we've had little pullbacks. You have to give that one to the bulls. However, they're not buying it up either. And what it seems to be is, especially in recent months, there's just a lack of buyers. It seems that those that are in the market, those that have been bullish, have maybe repositioned on the dips, sold out at some of the highs, but they haven't been able to take this market anywhere just barely above the highs. And again, we're still below the highs on the Nasdaq, the recent highs. So we're virtually going nowhere here, and it indicates there's just a lack of buyers in this market, and that those that are long are holding on, refuse to sell, and this will resolve itself sooner or later. So let's just look at the technicals. This is a simple chart of the S&P 500. We've broken below both primary uptrend lines, or I should say both uptrend lines. One's a primary, this yellow one, the secondary uptrend line, and have pretty much slogged around sideways now for years. There I have this, broadening wedge, divergent highs. These are things that I've been focusing on for a while. And for those of you not familiar with a broadening wedge pattern, they can take a while to play out. And if you go back on the site, you can check these posts. This was all posted in advance. I was tracking this broadening wedge pattern in the gold mining stocks when they topped. And as you can see, I'm going to drag using the measuring tool. This pattern formed over a period of 1.6 years before it broke down. The one in the S&P 500 right now that I just showed you has gone on for about 2 years now. So that's, again, we're looking at a weekly chart. This is 10 years time period. 10 years of price action on this chart. So in the scheme of things, a 2-year, 1.5, 2-year broadening wedge or topping pattern is not out of the norm as far as duration goes. In fact, that's what you'd want to see on a weekly time frame. You want to see a pattern that forms over many months, if not a couple of years, and that's exactly what's gone on so far in the S&P. So this one we shorted right there, shorted that partial rise. That was, the only other better short entry you could have had on GDX was a day of the highs. That one was pretty darn good, and we milked that for a good way down on the mining stocks. And again, these are long-term topping patterns. You get a broadening wedge topping pattern. If it does break to the downside, that's likely giving you a sell signal that can last for years, and it did in the case of GDX, as you can see. So back to the S&P 500. There's our broadening wedge pattern. We're at the top of it now. So anything can go, but again, we're looking at the recent price action. You see the negative divergences, and let's take a look at the SPY real quick here and go down to a daily chart. Now this is what I wanted to point out. In fact, PKM in the trading room pointed out yesterday that the S&P 500 closed at the lows, and that's quite bearish. So what we're seeing now is possibly some change in the supply-demand dynamics, and what I'm referring to is institutional distribution. The fact that oil popped up, we had the OPEC meeting, they've agreed to the first production cut since, what was it, I think 2008 I was reading, which is huge. And as you guys know, oil rallied, it's up again today, and that historically has been very bullish. In the last couple of years, the stock market has had a high positive correlation with oil. In past years, high oil prices aren't good, but when they're this low, you can take a rise. In fact, it's beneficial for the U.S. stock market because there are so many companies, energy companies, that are dependent on the price of oil. There's a ton of companies on the verge of bankruptcy. If oil prices don't recover soon, or if they go any lower, we all know that that'll have a cascading effect of in the financial markets, because a lot of it's banks that have a lot of those loans out there. There's shareholders with a equity stake, and there's also banks with a lot of money lent out to these companies. So where I'm going with this. Okay, let's take a look at what happened yesterday. This is a 1 minute chart. So here's yesterday's price action. You can see the big pop. Oil went up. The S&P 500, I'll just grab from yesterday's lows. You can see the daybreak lines right here. I'll do it from there. Okay, so we opened up and we rallied up about a good amount. Went positive to the tune of about 1.4% or somewhere from the open, which was also up from yesterday's, I should say Tuesday's highs. Nearly 0.2%. But then look at the sell-off. So this was good news. That big spike in oil only took the market up that much. Again, from the close, where was I? About 0.1415%. But then look at the selling that it was met with, and that has been the trend recently. Now, I always say, I like to say that one day does not make a trend, but the point of this video is let's be on the lookout for this, because day after day, if we continue to see this, we're seeing now selling into any good news. Lately, that's been the trend, end of day selling. This is possibly institutional distribution. We had a pop, largely based on that good news from OPEC, and then look at the fade there. Got a little oversold. Dip buyers are going to continue to step in, and if my read is correct, and this is institutional distribution that we're seeing, then what this is retail buying. These are your dip buyers that think the market's going to go to new highs or continue to move much higher from here. And so, it's simple. If you want to look at it this way, we have a short-term downtrend right now. Let me clear this out. Downtrend line off the highs. That's one level to watch. A rough downtrend line in the SPY. If they take it above there, that would be bullish. But right now, the near-term trend is lower, and let's see what happens. Here's another pop since yesterday's highs. Recovery at the lows, but we still close the day down below where we started. And so we're rallying. Let's see what happens today. Do they take it up? Here's your levels. As we go, as the market rises, and we have a couple levels here to note. And you have the previous reaction highs from yesterday. You have the downtrend line, of course, that I mentioned, and then you have these recent highs. So, we'll take it day by day. That's all this is right now. I'm looking. This is a battleground. In the very near term, you have the sellers in control, because as you can clearly see, in the last couple of days, the trend has been down. But again, that's the very near term, and try not to read too much into that picture. We look at the 60-minute chart. These are also charts that I posted yesterday. We do have a breakdown of this ascending price channel. We had negative divergences, so I'm just awaiting additional confirmation for my trend indicators, which are this 1333. These are the EMA pairs. When they cross over, that's bearish. It's done a great job of defining the near-term trend. It's, again, a 60-minute chart if you look up here, hourly chart. And the other indicator, of course, being that MACD crossing below the zero line. All right. Another thing is when what you want to watch for in the market is, and we've seen this in the last couple of years, for the most part, they haven't been able to take this market down because good news as well as bad news has been absorbed by the market. Market rallies on good news, but when you see the market rally or at least shrug off bad news, that's bullish. And that has been the case recently. However, when you start seeing the market sell down, as it did yesterday on good news, the big spike in oil, and so far, again, oil's up. As I'm doing this video, I'm looking at USO, and it's trading up over 3.5%. Yet here we are, and the SPY is virtually flat. You can see it up here in the corner, 0.08. It was just 0.05%. So virtually flat. Something to watch for again. And I think we have some economic reports coming out today. In fact, one may have just come out, I think at 10 a.m. Let's look at the Qs. Here's the Qs selling off pretty hard recently. Look at the pop that they had in the drop yesterday. So again, yesterday was, by all accounts, bullish. They sold that news pretty good. They're rallying it right back up. This is an interesting level, one to watch as I'm doing this video. So we have the reaction highs from yesterday, as well as there's some highs back there. So this is really the level. Let's see what happens right now with the Qs. By the time I publish this video, it should be out, and you can see, and again, this is just a very short-term chart. There's your next resistance level. So if the Qs manage to pop and hold above this level, again, these are 1-minute charts. You can have these intraday spikes. This would be your next resistance. If not, that's bullish if that level's taken out. You can see it there. It's about 117.50, a little bit above there. 60-minute chart, what does that tell us? Because again, I don't get caught up too much. It's a little bit sloppy right now on QQQ. I don't see a lot there worth mentioning. But again, longer term, this is what really formulates my take or near-term bias on the market is these series of divergent highs. I mean, I've harped on these so many times. I try to keep my trading style, as simple as possible, not incorporating too many indicators or elements in there, because the more that you put in there, you tend to have the issue where you suffer from paralysis by analysis. In other words, if you have 10 different indicators or all these different things you're using, especially in a sideways trading range, I can tell you that you're going to be plagued with whipsaw signals. That's what we've been in for years now, a sideways trading range. And yeah, we have these little dips and rips, and that's where the intraday charts come in. And the daily charts can help, but don't use too many indicators, because if you have a dozen you're using, and right now, you're probably going to have half of them on buy signals, the other half on sell signals. So I like to keep a couple things on here. You can see the PPO and the MACD, which are very similar. I talk about that a lot. In fact, I can get rid of one of the two right now. Let's just clean this chart up, put the PPO over here. Now, it's very clear, and I've gone over this so many times. We've had these series of divergent highs. Yes, the market is walking its way up. Or has been since that point. This is the Qs, but as you can see, without exception, we've had these divergent highs. These are where you want to be on the lookout for corrections. Now, yes, I'm only pointing out the bearish stuff here, but I have pointed out in the past. You can see these bullish divergences. You go back on the site, we were short coming into this. We covered here. If I'm not mistaken, I was scaling out either right at the day of, the day before, and certainly no later, usually going long at the lows on these, because the 60-minute charts confirm. You can see divergence there. You can see the divergence there. But my point being, divergent high at this point with that little circle, correction. Divergent high, correction without fail. So this is what I do. I look for divergent highs and lows, and much more often than not, they do result in a correction. Now, this is really a series of consecutive divergent highs, which I keep mentioning. Sooner or later, the big one's going to come, meaning An example I'll use, it might be a crazy analogy. A few years back, my wife bought my kids when they were young this game. It's called Jenga, Jenga, I think is how you spell it. What it is, it gives you a bunch of wooden blocks. They're rectangular shaped blocks, and you stack it up. You make a tower out of it, and you take turns putting your block in. And the point being that the higher that tower gets, sooner or later it's going to crack and fall. And I've watched the kids, when they're little, they started playing the game and get about 12 inches tall, and somebody's going to knock it over. They put the wrong brick. It's not a big mess. However, when that tower gets built up to 2-3 feet tall, and then everybody's getting nervous. Finally, somebody puts a brick on. It's not level. The whole thing comes down, and it's a big mess. This is what's going to happen here in the market sooner or later. Maybe it goes to the upside. I'll keep all options open, but I don't see it that way. There's just too many divergences, too many signs in there that's saying the next big move out of this multi-year trading range is to the downside. And even if you're not looking to play the long game right now. Long, like in golf, your long game is the distance shots. If you're just focusing on the short game, meaning the near term, your swing trading, then here's what you need to pay attention to. We have this most recent divergent high right here at this point. Let me circle it to make clear. This was where the divergent high was because we have yet to make another high. So at this point, we have a pretty strong on the daily time frame too, mind you. This isn't the 60-minute chart. This is a daily time frame. These divergences play out for more than just a few days. So yeah, you can say, okay, well, Randy, we already had a drop. Based on the scope of these divergences and the fact that it's really a series of larger divergences going all the way back here to this point in time, you can see this divergence. It gets even steeper. This is what I call double negative divergence. I'm looking for something much more. So you have this yellow uptrend line. This little blip was a pullback. Now, you might say, well, in the market, what if it goes on to make new highs? Absolutely, let it come. Look at this. We have plenty of room here. I'll take this downtrend line. You can really extend the one that's there now out, and like I'm doing here. You can do the same on the RSI. We can go anywhere here. My point being that if the market pops up, if it pops up to a new high, that will still be a divergent high. It would have to go way up here. You'd have to have the MACD come this high, or I should say above this high back here. You'd have to have the MACD come all the way up there to take out those divergences. Same with the RSI. It has to come above this previous reaction high. So right now, most likely scenario, I don't think the market's going to go on to make new highs from here, but it's certainly possible. I didn't think it would back here. So anything goes. But if it does, look at that. That would just be another marginal new high. Keep these divergences well intact. That's the thing. That there's such steep divergences right now. The market has room for another new high. And is it frustrating? Absolutely. Whether you're long or short, this is just a frustrating, sloppy, sideways trading range. And my point here is just don't give up, but also don't jump the gun because we may be in a trading range for a while, and that's why I'm holding off right now and adding the indexes back as official trade ideas, whether it's long or short. But this is something to look for, a break of this. See this yellow uptrend line? In fact, so the yellow lines show a big, large wedge, confirmed with divergences. Let's put these back to where it is. And if you flip back to a weekly chart, you can see here, this is the primary uptrend line off the lows and back in 2009. And this is that same, I had it yellow on the daily chart. You can see this white, large, triangle, wedgish type pattern. Very strong, especially on the Qs, which have been the leading index for years. Very clear and powerful negative divergence. The type of divergences that these span years. And these are the type of divergences that don't just lead to corrections. They lead to a primary trend reversal. And you can see now we finally at this point have an uptrend line with 1, 2, 3, 4 reactions. That's plenty to validate it, and so that looks like could be the flashpoint for a big sell-off. And remember, the longer you have these choppy sideways trading ranges and areas of indecision, the bigger the move is once it resolves itself. So if you zoom in, you can see some support there. You see a trend line. That's what I'd be looking for on QQQ. SPY. I don't have it drawn here. I have a lot of different boards. I probably have it drawn elsewhere, but you can certainly put an uptrend line there. Maybe just count that as a whipsaw signal. And I also talk about this a lot. You want to watch all these indexes, especially the leading indices like the SPY and the Nasdaq or Nasdaq 100, and maybe keep an eye on the mid caps and small caps, but they eventually follow the large caps. So these two alone, when you see the SPY and the Qs confirm sell signals, that's go time right there. Okay, we're at the 20-minute mark, so I'm close to wrapping this up. Like promised, want to keep these under 30 minutes. A couple other things to note here. We've had just whipsaw signals. These are the trend indicators that I often use on the one of the trend indicators on the daily time frame. The MACD signal line being above or below zero, as these green boxes indicate. That's the white line, the last of the two to cross. So we had a sell signal there. We also had a break of support. And this, again, this is a signature of this market. It is just, I haven't seen anything like it in years. Whipsaw signals are a dime a dozen when you trade. You can see them once in a while quite a bit. But this market has just been plagued with this. That was a pretty clear break of support there. Now we had a breakout to new highs. We had a breakout of new highs here. These were the previous highs back in 2015, so we broke those right here. And you would think, okay, well, we'll see the market blast off the new highs. Didn't do that. In fact, it came back into the range, tested those highs, fell back below. Looked like a failure at this point. Look at that impulsive selling, only to see things rip back up. Now, given there was a little bit here, this was largely, in fact, almost completely due to the election, the surprise election results here in the U.S. And sometimes news can trump the charts. But from a technical perspective, you have this uptrend line off the lows in the SPY, reactions there. We're just backtesting that at a higher level. We still have divergences in place. You see this line? These are a series of divergent highs. I've showed this on different views on the S&P 500. It's really 3 consecutive divergent highs, but this divergence is still intact. So yes, while the market makes new highs, it is encouraging for bulls. It is frustrating for bears. But I've been trading for many years, and divergences are not the be-all, end-all. They can be burned through, but right now I'm looking at what's about to be confirmed divergence. If you zoom in here, you see the MACD rolling over, about poised to make a bearish cross. It hasn't done so yet, but if and when it does make a bearish crossover, that will then have confirmed this negative divergence. And again, that's powerful divergence. You see the RSI rolling off oversold levels. There's another thing. How many times have you seen the RSI hit oversold readings? Last time we had an oversold reading on the RSI was over here. Market went up for just another week or so there, and then came back in, made a marginal new high, but that was a divergent high. So there it is. So you had and you can draw it here on the MACD as well. It's not drawn. I'm sorry, the RSI. So that high there was a divergent high, and then we had a correction. So everything's in place, guys. You can't. It's hard to ignore all these bearish developments, and it's also hard not to get frustrated with the fact that the market continues to give these what appear to be sell signals or even buy signals, yet just as soon as they start to look to be playing out, they tend to reverse. So what I'm watching for now, again, is a theme of distribution. Let's just keep an eye on the price action. We've seen so far last week, we had Thanksgiving last week, and that was marked by declining volume. So the market rose the week of Thanksgiving, which it usually does anyways. And yesterday, this is something to note too, is not only did the S&P 500 sell off into the close and fade all those gains and then some, it did so on high volume. We haven't had volume this high since the elections, the 2 days following the election, which was the highest volume that we had in quite some time. So that is also something to note. So that selling, that profit taking occurred on very high volume, which is also indicative of institutional distribution. We look at the Qs, same story. You can see it here. I hope you can make that out on the YouTube video. If you can, I'll turn my volume bars up here. There you go. So there it is. Very high volume on yesterday's sell-off. And again, the day started out good and they faded those gains. The recent rally, as I mentioned, came on declining and low volume. So that calls that into question, really. Volume is just a confirmation of a move. If a move occurs, whether it's a gain or a loss on very low volume, that it just shows lack of conviction. What you want to see is high volume on those moves. So we've just had just a ton of whipsaw signals lately. Here's the cues. Let me just show you this on the NDX and I'll wrap it up. And this again is indicative of this market, and that's why more focus on sectors. Yes, I'm doing this video on the broad markets because I know people enjoy analysis and they want to know where the stock market is going. But as far as trading it, it's been tough lately, long or short. So here's an example. You see this candlestick here, followed by the very next day a bullish engulfing candlestick. That means that candle was larger and engulfed that previous candle. Those aren't very common. They're not super rare, but not very common. They're bullish. And then what happened the following day? Let's go get this. We had a huge bearish engulfing candlestick. So, this is just quirky, crazy price action. Those both came on very high volume. And now what I'm looking at here is, we had a decline in volume since then with a little rally that really didn't, so we didn't have the needed follow through. We had 2 days of downside follow through to the bearish candlestick. Then we had the post-election rallies. Again, the news trumped the charts, no pun intended. And now we have so far. Look at the cues really rolling over, and that's something I've been watching too and pointing out. There's the very crooked line, but you can see the NDX Nasdaq 100 is still well above the. Well below its previous highs. All right, let's wrap it up here. So just keep an eye on things. Keep an eye on any rallies being sold into, support levels giving way, and we'll take it from there. But right now, I see just an overwhelming amount of bearish technicals built into the chart, built into the charts. Excuse me, there. Just had a little issue with more likely to see some downside here in the coming days. And again, that has a lot to do with the 60-minute charts. And I don't think I followed up with you guys on the QQQ 60-minute chart. Oh yeah, I did that one already. It was the IWM that I didn't do, and we did that yesterday. So there's the IWM. It's below that 132.20 level. You can see after we broke, like I said, we haven't had impulsive selling in IWM yet, but we certainly have a breakdown, and it's respecting those levels. You can see it's failed. This is a failure. This is why I always say I use closing candlesticks on the 60-minute chart when trading the 60-minute chart, because that little wick right there, that's an intraday, or I'm sorry, an intra-period, intra-60-minute period spike above, another little candlestick wick above, but the body closed right on resistance, and now we're moving lower. So you want to see the IWM, for those of you that took that short, it's unofficial, but you want to see a move below this line here, around 131.50-ish, really below yesterday's lows, and that should open the door for a move down to any of those targets. You can see my trend indicators I mentioned yesterday in that video. They had flipped to bearish, and they're now a little bit more in bearish territory. So it still offers an objective short entry, guys, and it's been a tough market. So I'm not going to say that I have the utmost degree of confidence this plays out, but I will say that I have the utmost degree of confidence that this is a very objective short entry. Why is it objective? Because there's your resistance level. You can run this thing with a very tight stop, on a 60-minute close, somewhat above 132.20, since that's the actual resistance. Let's say 132.30. Or 132.50 if you want to give it that, and you do a 60-minute close above that level. What does that mean? Well, it means your downside, if stopped out, is negligible. We're talking, I don't even know, measured out 1% or so, and your profit potential, as I went over yesterday, is quite large, especially if you're using, the leverage washes out. You use a 3-time leverage ETF, you really should take a third less, but like I said, there's such a small downside. The only risk you have is maybe on a gap above that, and then you slightly exceed your stop. But that's what I think is going to happen here in the IWM. And again, that's still, you're right there. You're still offering an objective entry, the same area you were yesterday, for about a 3% drop to that target and 4.8% to the next one. All right, this has been Randy Finney with Right Side of the Chart, and I am going to wrap this video in just under the 30-minute mark. Have a great day.